Now today we have with us David Grossman. Now there's always a further protection that goes into these things. It's called mortgage insurance. I know when you're dealing with a bank, they're very, very prompt to want to line up mortgage insurance.
Absolutely.
Now this isn't insurance for you, is it?
Well, this is insurance for the borrower, life insurance and/or disability.
When I said you, I meant the book.
Yes, it's insurance. Well, I mean, if one person, the estate, if the mortgage is paid off, if a person dies, let's say, then the home goes to the estate free and clear.
Yeah, right. So it protects other people, but not the borrower.
Well, no, I mean, if there's, let's say there's a husband and wife, it might protect one of the borrowers.
But the main person that it protects is the lender.
It protects the lender.
Because the money, if I'm married, if I buy a house in my name,
yes,
and we'll call it $1 million house, and I have a $500,000 mortgage on the thing.
Yes.
And then I die, and with insurance, with a mortgage insurance, the insurance company will write a check to whom?
Well, if you get regular life insurance, you name the beneficiary. So normally you name the beneficiary as somebody in your family.
But that's regular life insurance, right?
That's correct.
Is that what they mean by mortgage insurance?
Well, the banks sell mortgage insurance, and I believe that if somebody dies, that the money goes straight to pay off the insurance. Or if there's a claim, it goes to reduce the mortgage.
That's why they want the mortgage insurance, right?
That's that, and also because they like selling add-ons and extras, because you know you can make a lot of extra money selling different things.
But you cannot buy the insurance from the lending institution.
You don't have to buy insurance from anyone. Okay, it's a good idea to do so, because if you're thinking about if you have heirs, if you have family, a spouse, and you're thinking about the spouse, and if something should happen to you, would you want your heirs to have to sell, or would you want them to be able to continue to live in the property? If you want them to be able to continue to live in the property, you think, how are they going to manage financially, assuming you're the breadwinner or the primary breadwinner. So your estate, your heirs will benefit by having insurance, and that's, I think, the main reason why people should get insurance.
Well, that speaks for insurance in general, right?
Yes.
It's always a good idea to have some protection against eventualities, right?
Right.
Yeah. We don't predict the future very well. As human beings, we're very, very poor at that.
Anything can happen in life.
But the whole idea of the concept, people hear about this business about mortgage insurance. Is it essentially an insurance where you're purchasing, in other words, it's costing you money, but you're insuring the lender from loss if something happens to you?
Well, yes. So, I mean, listen, if you died, if you die and you have a mortgage, it's not like the mortgage disappears, right? They'll still have a legitimate charge on the house. Because the question is how will they pay for it? If your income is gone, you may not be able to service the debts.
If you're gone, your income's usually going to be gone, right?
Right.
So that leaves the lender not getting paid.
That's correct. So whoever is managing the estate.
Is that why they insist on you having insurance?
Well, they don't insist.
They don't?
We have to offer people insurance, and they don't have to take it. We have to offer it to them, because I've known there were cases before where, let's say, somebody bought a house, and the minute you sign and your purchase is firm, like you've waived all financing conditions or anything else. Let's say that house is closing in 60 days.
Right.
If you die between now and the closing, you still have to proceed with that contract. Like your estate takes it, right? Yeah. So there was a case, from what I understand, where it was a husband and wife, and the husband died, and then the wife they didn't have insurance, and the wife was sued. Because she didn't close on the house, but she couldn't close, but she was sued. So that's why the minute you firm up your deal and you're dealing with your bank or your mortgage broker, you don't necessarily need to take the insurance from them, but it's a good time to be looking at insurance for your own benefit and for the benefit of your own heirs.
In the example that you just gave, the purchaser dies before the closing. The spouse, the beneficiary of the estate, okay, was then responsible, or the estate, because it's her, she's it basically. That estate is responsible for closing the sale.
That's right.
But the lender wasn't committed?
Well, the lender the lender can back out. See, because when we get people a mortgage approval, usually it's a conditional approval. And, you know, like we'll submit an application and we'll say this person makes a certain amount of income. But the lender can get out of that deal up until like the day of closing. So a lot of times lenders are verifying
so they'll back up because now
employment.
the person doesn't have any income, he's dead.
Yeah, to verify the employment or something, yeah, they find out.
And yet she can't back out of the sale.
That's right.
So it's kind of a one-way street, right?
It's a one-way street. Yeah. Well, death is never a good, usually not a good option.
The Glass is Half Full Talk Show.